Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. With me, my good friend and special guest, Dr. Friday with Dr. Friday's tax and financial firm over in Brentwood, Tennessee. She is a tax expert for individual tax returns as well as for small business owners, as we were just talking about before the break, how that can work. When you're, as I said, I've got clients that are retiring that continue to work, not because they have to, but because they want to. And it's not to say they're going to keep the same schedule even that they had, prior to retiring. And so retirement looks different today. What I find with boomers in particular is they like to stay active. They like to be doing things, okay? And so with that, if they've got leisure activities they like to do, then that's what it is. If it's about being involved with their church and doing volunteer things or mission trips or, whatever it is they want to be doing, they want to be contributing still. And that's another big plus, whether in their communities, in their families, or in this situation sometimes with work. Again, as I mentioned, consulting or starting a business or working, just on a part-time basis, typically, maybe a couple of days a week. I've got teachers that continue to teach at college, do a couple of classes.
Active. I mean, and it always sounds great. I think all of us are like, oh gosh, I can't wait till I retire. I no longer have to do this. I can just relax. But then after about 6 months or so, they're usually sitting there going, okay, what am I supposed to be doing? Because they've gotten up every morning, gotten dressed, put their clothes on, went to work, and then after about 6 months of not having that mandate, you're usually looking for something to do. Either you're repairing the entire house. I've got some that have different projects that do need to be finished. They're like halfway through several of their projects. But you mentioned earlier the experience. These people have 40, 30 years of experience in industries that they still can't replace with computers. They can't replace with anything but that knowledge, and so they can bring that back to the workplace on their own terms, which is awesome.
Exactly, on their own terms being the key here. So that's one of the areas. Now, if this is your situation, we get again into the complexities of the tax law and the tax code. So one of the things when it comes to retiring is think of retirement in stages, okay? One of those we're going to talk about a little bit to start is that of pre-retirement. So now we're leading up to retirement. Those retirement years could be from age 50 plus typically that we think of that, 50 to 60 maybe. And some people, of course, are retiring earlier. So we see, I've got clients that are retiring in their mid-50s to, early 60s. And now we have other considerations, healthcare cost, and again, managing all of our different costs are so important to keep more money in our pocket. So that means managing our investments. That means managing taxes on our investments and on income. As I said, the areas that you get into when it comes to retiring and you start thinking of transitioning from wages to Social Security, and again, if you have a pension, to that, and when you're taking money out of your retirement accounts, which is now going to be fully taxable, right? Now, if you've been wise and maybe you've got some money in Roth IRAs, okay, or a Roth 401k in addition to your traditional savings and 401ks and IRAs, that's going to give you some more flexibility when it comes to tax planning and managing your taxes in retirement. There was a time, and this is one of those strategies that's real important to understand, because just like that example we gave you with the brain teaser up front, it seemed like the obvious answer, right? 22%, 220 bucks. What do you mean 40%? How could it be 40%? The tax code does not always follow logic, or it doesn't always make sense. What seems to be the obvious answer is not always the obvious answer. If you don't know how that tax code works, you can set yourself up to pay thousands, tens of thousands, maybe even hundreds of thousands of dollars over your lifetime in taxes that you would not have been required to pay, just understanding the rules and understanding how important planning is. This comes to that income part as well, and on your investments. So let's talk a little bit about, let's see here, we've got, what's our next slide on this one? I think, yes, let's put the warning up.
Seek tax.
One of them is, do not attempt this on your own kind of thing, right? When it comes to understanding the rules, the tax code is pretty complex and it's huge, and the differences in all the different rules between things like traditional IRAs, Roth IRAs, understanding about the Hall's taxes, for instance, here, if that's going to impact you. There are so many different factors. Taxation on Social Security benefits, what deductions you can take. You know, standard deductions gone up, itemization has gone down as a result. Charitable qualified distributions, QCDs, understanding how those can help you. There's so much involved when it comes to tax, and this is where you'll need some tax help. Okay, this isn't something that I would recommend you try to do on your own.
And it is different for each individual. So just because your person that you're working with may be in the same income bracket, he's married also, maybe he has no children at home, and you're like, well, this is what he does, so it should be the same for me. It isn't always the same for you. And maybe that there's an inherited IRA involved, or there's other moving parts. So it really is very important to make sure when you're doing your taxes. I can't tell you, every week I have people come in, and at least they're smart enough to actually come in and get that tax advice, but they've already done their taxes. And then they're afraid they've done something wrong. Gentleman came in just yesterday and he forgot 2 major credits he was entitled to. He didn't even know he was entitled to them because his life had changed. He was no longer working. He was self-employed. He had self-employed health insurance. Didn't know he could take health insurance off. He didn't realize he had a lost carry forward from 17 that his system did not roll forward. So these are things that he left money on the table. He forgot to report some income, but all in all, there was a way of helping to maybe lessen the blow of the unreported income to make it work out. So it is important to know what you're looking at.
And this goes to, it's a different world today, okay? What we're looking at today is a much more complex world than it was. An example, you know, when I was starting out 30 years ago now, but in that first 20 to 30 years ago kind of situation, my clients were different. Okay, they typically had bigger, pensions. They had pensions, they had bigger pensions. Right. They were able to live, many of them, on their pensions and Social Security.
Absolutely.
And the savings they had, other than maybe, and even RMDs were not that big a thing back then because IRAs and retirement accounts had not been had not been around that long. And if you're talking about 1990, okay, which is when I started in business. So 1990, if you think about that, at that time, IRAs and retirement accounts had only been around for basically less than 10 years, or at least being fully used or starting to come into vogue. It was through the Tax Acts of the Tax Revenue Act of 78 and ERISA, which I think was in 1974. Those are the two that brought into play IRAs and 401ks, but they didn't actually start getting used mainly until the early 80s. And that's when the mutual fund industry also started to take off. So understanding this history and how it works with regard to tax planning, it's a different world. So people at that stage, if they had IRAs or retirement accounts, they didn't have much in them because they hadn't been around or been able to contribute. And back then, I think it was only $2,000 that you could even put in a year. So you can imagine. All right, now, fast forward, you get into today's world. Now, very few people, only 20% of the population or the working force, that is, has a pension.
I didn't even know there was hardly any left.
So, and then most of those are much smaller pensions. I've got clients coming in and maybe they're getting, like $10,000 a year, if that, from a pension. That's not going to go very far, is it? Okay, so Social Security, and then you get into your savings. So your 401ks, your SEPs, again, whatever you have, thrift savings plan, whatever it might be. That's what we're dealing with, which means what happens? You've been saving along tax deferral, and accountants love saying, put that money in there,
oh, that's
reduce
right.
those
We can
taxes.
save you instant gratification. Put some money aside, and instantly we can reduce your tax bill.
And that's what the deal is all about, is how to get that done for this year, how to reduce taxes. But we want to have a longer view when it comes to retirement. Because when you're retiring, people are living longer. We know that. So you're talking 20, 30 years in retirement. So understanding in this world, in today's world, the planning is more complex than ever. It was much more difficult. I mean, back, like I said, 25, 30 years ago, 20, 25 years ago even, it was easy. We could, investing was easier. We knew this money wasn't going to be drawn down that quickly. It was typically non-qualified as opposed to money in IRAs and stuff. So it was much simpler. Today, not so much. Today, we've got to worry much more about taxes and tax planning as a part of our retirement. So one of the things when it comes comes to preparing for retirement then is how to organize your retirement accounts. All right. Another part of that is understanding this when you're taking income in retirement, how different that's going to be for you when it comes to your tax planning. And it gives you, in one way, it gives you more flexibility, right? When you've got a salary and this is my income, it's more, we can put money into retirement accounts, but we're more limited. We can do some things, but we're a little more limited in terms of those strategies. But now as we're taking money out, as we're in retirement, we can get into maybe some more creativity, if you will, on how to minimize taxes in retirement. But we're going to talk about pre-retirement, preparing for. First, another break. Join me here. We'll be right back on the Retirement Report.